Hello and welcome to NDTV Profit. You're watching IPO Adda, and the company in today's IPO Adda is Happy Forgings Limited. It's one of the leading players in the forging segment in the country. The company is coming out with an IPO which opens on December 19th and closes on December 21st. Price between 808 and 850 per share. The IPO consists of a fresh issue of 400 crores and OFS of 608 crores. So total of over 1,000 crores, the size of the IPO. And joining me today is Ashish Garg, who is the managing director of the company. Ashish, thank you very much for joining us on NDTV Profit. My first question to you is with respect to the fresh issue of 400 odd crores that you are raising from the market. Where are you going to deploy these funds?
So the major use of the funds, will be for the expansion purposes, and the proceeds will also be used for the repayment of the debts and for general corporate purposes.
Give me a sense of, Ashish, the kind of operation scale that you work on, how many factories are there, and what kind of capex requirement is needed for you?
So today we have 3 plants spread across 74 acres in Ludhiana. All 3 plants are in Ludhiana, and today the total block is around 1,200 crores. Almost 500 crores of capex is done in the last 4 years. So company requires, it's a capital intensive business, and we require to do regular capex, and company is in a mode. We are seeing a lot of strong tailwinds, and a company will maintain this trajectory going forward as well.
Can you just maybe briefly touch upon the kind of tailwinds that your company is facing as of today? Because as you said, around 500 crores of capex you have undertaken in the last 4 years or 5 years. What kind of tailwinds are you seeing? Where is the demand coming from? Which segments are the ones which are growing very fast, which require you to constantly put a capex?
So company has consistently grown in the last 10 years. So if you look at, we have grown at a CAGR of 18% in the last 10 years. And in terms of top line, that is despite of COVID. And going forward, we feel that, company will be able to maintain a better trajectory and growth. With the primary fundraising coming in the company, we will be accelerating our growth going forward as well. So capex that company will be seeing, because company is looking at a very strong cash accruals going forward as well. So definitely we'll be deploying around 900 crores in capex in the next 3 years.
Can you give us a sense of the tailwinds which are there? I mean, which sectors are you seeing a lot of demand coming from? Because you're primarily into commercial, farm equipment, off-highways, and industrials.
Yes. Yes, so currently we operate into all 4 sectors, but on an industrial space, we see a very strong growth coming in. The business, which was 3.7% of our revenue last year, has grown almost 14% in H1 of this financial year. So going forward, we see industrial sector to accelerate and grow at a faster pace than the other sectors, probably hit a 20% level, for us in next financial year. And we see a major set of growth coming in from Europe for us. And we have added almost 30 large clients in the last couple of years. In the last 5 years, we have added 36 large clients across the sectors, out of which 24 industrial clients are added in the last 6 years, which are in a phase where we are ramping up with all these customers. So we see this industrial sector doing well for us going forward. Even on the commercial vehicle space, we have added some large client base within India. And even in farm equipment sector, we have added a few more names in customers. So we see even these sectors doing well for us going forward.
You spoke about the fact that how industrials are going to be a large portion of your revenues going forward. Where is this, what kind of activity or production that you do for the industrial segment? What kind of equipment do you manufacture for this segment? And as you said that European markets and other global markets are the ones which are seeing quite a few demand for you. Can you give an elaboration on the kind of work you do? And as we speak today, and maybe going forward, will the business mix change for you in that way?
So for us, within industrial sector, we supply to windmill, wind power. We supply to oil and gas, railways, And in the wind sector, especially for wind turbine gearboxes, we are seeing a very strong traction, very strong growth in this sector. And so majorly we have customers like Bonfiglioli, Lieber, Comer, which are in this field, and will be growing this business going forward, especially in the wind turbine sector.
That's interesting because renewable is having a big play as we speak. Do you see a good opportunity in the Indian market also for the industrial segment?
Some of these large clients, they also have their factories and investments within India. So we are suppliers to their Indian locations as well, and we are also exporting to their facilities in Europe. So basically, we started our 14,000 ton press line in last financial year, which is the second largest line in the country, where we are able to forge components up to 250 kg. So we have expanded our range from 90 kg to 250 kg. And the heavy sector, heavy range of products that we are forging on our 14,000 ton press line are towards the industrial sector, which includes the wind turbine sector as well.
Give me a sense of how your balance sheet is geared towards this capex program, because you're raising fresh capital as well. How big is your balance sheet? And as you said that you have a good capex requirement over the next 3 to 4 years. Is your balance sheet generating enough cash to take care of it?
So despite of being in a capital intensive business where asset turns are fairly low, today we work at a debt equity of 0.22, which is best in the industry. And despite of doing a capex of almost, despite of doubling our block in the last 4 years, we stand at a balance sheet which is very light at the moment, and we are at 0.22 debt equity. And going forward as well, we are looking at rich cash accruals. Our 80% of that is deployable in the capex, and with the primary fundraising coming in the company, we are looking at a very strong cash accrual going forward, out of which 75 to 80% will be deployed towards capex. So even with the type of capex we are seeing going forward, we feel that the debt equity levels will stay range bound.
Give me a sense, you're dependent on your top 10 customers, nearly 71% of your revenues are coming from the top 10. How do you bring down that dependency on the top 10 customers?
So for us, we are not into a sector specific business, and like many auto component companies, we have not grown with one godfather. So it is fairly diversified even today, and we have 70% of the revenues coming from 10 large clients. Going forward, we see the client concentration will get reduced. This was 80% last year in FY22, and it was 70% in FY23. And going forward, we are seeing around 65, 67 in FY24, and we see that it will be around 60% in next financial year. So it's going to, in terms of concentration, it's going to get reduced going forward.
Can you give us a mix
within
of
the same clients,
yeah,
we have also started. Between the same clients, we have also started exports to some of our clients' facilities. And so basically in terms of, we have added more and more locations, even though the number of clients, the top 10 clients still holds a large position, but we have started exporting to their multiple plants now.
Can you give us a breakup of these top 10 clients in terms of the sectors they are in, maybe commercial vehicles, farm equipment, industrials, or off highways?
So for us, our top client is Ashok Leyland, that's a commercial vehicle client. Second largest client is JCB, that's for earth moving sector. And then we have Dana, where we supply for off-highway sector. And then we have a lot of clients in a range of 3 to 5% spread across, commercial vehicles, farm, as well as off-highway customer range.
I see from your RHP that you have nearly 48 Indian customers, which account for 90%, and with now industrial growing going forward, and you're going to export more of that. Do you see the concentration of the Indian clients coming down and more of an export led growth coming in for you?
Yes, so exports, in terms of exports, we have grown almost 6x. Exports in FY21 was almost 60 crores, which will be around close to 300 crores in this financial year. We have already clocked 21% direct exports revenue in H1 and 11% as indirect exports. So going forward, we see exports sector to grow. So the businesses which are in pipeline today, around 700 crores of annual business which is in pipeline, 60% of that business comes from exports. So exports is definitely going to grow going forward for us.
So you're saying your order book is around 700 crores? Is that the thing? Or the total domestic and international order book
in addition to what we so yes. 700 crores in addition to what we are going to do this year is what I am discussing. So if, so we have already done 676 crores of revenue in the first half, and so in terms, if you see the additional incremental order book that we see is close to 700 crores.
Give me a sense of how do you book orders, Ashish, in the sense, are they short-term orders or is a long-term order that you get from these clients, because your clients are across verticals?
These are very long-term businesses. Is a very clear barrier to enter in the business because the testing and the gestation period is too long. So normally when the customer floats an inquiry and once the business starts, once the development process starts, it typically takes around 3 years to actually onboard the client and start the ramp-up process. So customer has to spend a lot of money on R&D and testing. So basically initial 3 to 4 years goes in testing phase. So the ramp-up activity typically starts from 4th year, and the peak revenue from these customers normally we see in 8 to 10 years scenario. So if you typically see our top 10 customers, the relationship is between 11 to 21 years old, and it's growing as well, and the business is also growing with them. So it's very large contracts, typically based on the production levels and a fixed share of business.
And you are part of the R&D of many of the clients, and so you are the preferred partner once they go into production, right?
Yes, we are a major source. In certain areas we are also single source to some of these clients, and a lot of the R&D and a lot of new developments. We have seen a fastest migration in India from BS3 to BS6. Now we are talking about hydrogen fuel, hydrogen combustion engines, flex fuels. So definitely the new developments which are going on, we are part of it.
Okay. And these segments are going to be future drivers for you going forward? Maybe not now, maybe 3 years down the line as companies go for commercial production of hydrogen fuel engines or flexi fuel engines?
Yes, so if you see our sector, our domain, it typically requires a long testing period, as already explained. So we are already there. So if it happens even by 2030 or even later, we are already there. Our products are already in testing with these clients.
Give me a sense of the kind of outstanding borrowing that you have. You are planning to pay off some of the borrowings. Once you pay off the borrowings, what is the kind of debt that will be there on the books, both short term and long term?
So we currently have total outstanding of 250 crores on H1 of this financial year, and out of which, if you see, we have a long-term debt which is relatively a very small portion, around 25 crores. So basically, the money that will be raised, out of which 150 crores will be used towards working capital limit. And in terms of the business today, the payables for us, because company enjoys a very strong reputation with steel mills, and the payables are around 20-25 days, and we can also utilize to have a better purchase on steel prices.
But I'm seeing that your trade cycle, trade receivables are around 300 odd crores or 323 crores in the H1, and the credit cycle is around 83 days. Is there an attempt to bring it down further?
It's a typical cycle in our industry. In fact, if you compare with some of our peers, it's best in the industry today, because for exports is around 110 days, whereas for domestic it is between 60 to 90 days. So I think it will be range bound. It's not much we can do on it, but it's one of the best today amongst the peers.
But since a large
we are
portion
not currently discounting any bills.
Okay. Go on.
We can anyways discount the bills anytime that we want, but the type of finance cost that we have, the discounting is expensive, so currently we don't see any need for any discounting of these bills. But if we want, we can liquidate this anytime, because we are suppliers to OEMs, so we can discount these bills anytime.
No, my reason to ask you this question was that nearly 90% is coming from, domestic customers and around 10% from international customers. So, and you said that credit cycle is between 60 to 70 days for domestic, and you're on a higher end of 83 or 86 days in the H1. So, is there a is there an attempt to reduce it, because the more the higher the credit cycle, you will have to keep a higher working capital requirement?
Actually, in terms of working capital, I think we won't be able to do much because it's a cycle which is kind of pre-decided by our customers. And but currently, where we work today is one of the best in the industries. So we are already, at a much better level, because on exports, it's around 110 days.
Ashish, can you take us through the kind of growth that you expect across some of the key players? Because since you are the suppliers to the OEMs, commercial vehicles and farm equipments, we've seen a recent jump in commercial vehicles, and farm equipments have been quite in the first half, and people are expecting a flat growth in this year. So can you give us some perspective from an industry point of view, because you are watching the players very closely, because they are putting in demands for equipments, your equipments. So can you give us shed some light on the kind of growth that you see in these two segments?
Yes, you're right. Farm equipment is down this year, and so it's expected to grow next year in single digit. Commercial vehicle, we are seeing double-digit growth this financial year, and I think definitely going forward as well, this growth will continue, because there is a lot of trucks which are being used towards tipper and mining application, and we are seeing a very strong trend in construction in the domestic sector. And JCB, one of our large clients in construction business, is actually doing very well, and we are seeing a strong traction coming from the construction side. So I think going forward, these sectors will keep on performing well. In the farm, definitely there is a dip, but it's something that we see that will get recovered in next financial year.
Do you see enough enough indications coming from companies that next year could be a better one for farm equipments?
So, sir, I am hoping that things will be better, because the pipeline stocks which OEMs are carrying at this point of time is low, and so the production figures were less in the last few months, and OEMs are getting rid of the stocks in production. So hopefully from January onwards, we should see a good traction going forward.
Ashish, give me a sense of what is the kind of inventories that normally companies keep, especially for commercial vehicles and farm equipment, when the going is good, in terms of good growth coming in. What is the number of days of inventories that they keep normally?
So typically OEMs, they work on JIT. They don't keep too much inventory within the plants, but they invoice it to the retailers, and the dealers normally carry these inventories. And so good part is that even in the commercial vehicle sector, we have seen the OEMs making money, and the discounts are removed in the markets, which shows that the effective sales are happening down the line. Because for several years we have seen major OEMs in commercial vehicle sector selling at large discounts. So at the moment these discounts are reduced in the markets, which shows that the effective sales are happening through these dealers.
That's a good sign, I guess, and that's also helps companies like
sign.
you. Just a final question on the capex part of it. You said you are embarking on a capex, and the fresh funds are going to be used for capex. By when do you expect this capex to be completed, and what kind of capacity will it add to your overall capacity?
So we are in a phase where we are regularly adding capex. Even this year, around 250 crores of capex is planned. For next year, capex is around 350 crores. And typically we are adding 15 to 20% every year in terms of forging and machining capacities, and seeing the businesses which are in pipeline and seeing the businesses which are coming, I think this growth trajectory will be maintained going forward as well, so which will require this capex going forward as well.
Okay.
So on a long steady basis, around 15 to 20% forging and machining capacities will get added every year.
Okay. Ashish, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit. Your IPO is opening on December 19th and closes on 21st with a price band of 808 to 850 rupees per share. Thank you for joining us on NDTV Profit today.